Or good afternoon, I should say. My name is Marco Dell'Aquila. I'm the chairman and co-founder of Inspiration. And I'm also senior adjunct professor of energy, resources, and environment at the Johns Hopkins University. It is with great pleasure that I welcome you all to Spotlight on Italian Renewables, hosted by Inspiration and supported by Orrick and Foresight. Our objective over the next 2 hours, if that's feasible, is to map out the latest trends and developments in the highly dynamic Italian renewables sector. And I think we will be focusing almost exclusively on subsidy-free projects. 2 years ago, Italy was poised to roll out significant quantities of renewables, and especially solar PV. And most, if not all of these, were going to be on a subsidy-free basis. However, if I look at our database, Inspiration's Data Live, I can see that actually the number of deals that have come to market is much less than all the hype that was anticipated. It is true to say that 2021 have been really difficult years for the economy with significant contraction. Maybe only Italy and the UK have suffered such economic contraction, and that's had a significant effect on the renewables industry. That said, the challenges that Italy faces, much like its other European neighbors around decarbonization over the next decade, means we need to hurry up. The sector needs to accelerate, and we need to deploy a lot more renewables energy projects. To help me to discuss these topics, I'd like to introduce you to two moderators. But I think if I call them moderators, I don't think I'm really explaining who they really are. I think both gentlemen are luminaries of the Italian renewable space. Without further ado, I will introduce you both. First of all, I'd like to start with Carlo, who will be chairing our first panel on merchant risk, and then I'll introduce Federico Gianandrea, and then I'll ask Carlo to begin his panel. So before we start, let me just tell you a little about Carlo, although everyone will be very, very familiar, but for those who aren't, Carlo is a partner at Orrick and the Global Deputy Business Unit Leader of Energy and Infrastructure. He has extensive experience in project development, asset acquisition, project financing. He typically assists sponsors, energy companies, utilities, PE funds, and developers, but has also got a huge track record in helping banks and other lenders. In addition to primary financings, he's also very involved in M&A joint ventures, both in Italy and internationally. Carlo's portfolio spans conventional power, wind, solar, biomass, geothermal, as well as gas and power grids. So vast experience, lots of good questions that he'll be able to answer. Our second panel, which is actually going to focus on financing solutions, will be chaired by Federico Gianandrea. And Federico and Carlo share a dark secret. They're both lawyers, so I feel that I'm in a minority here. Federico joined Foresight in 2010 and is a partner based, well, as far as I can tell, everywhere. One day he's in Rome, one day he's in Milan and Madrid. He effectively looks after all the non-UK activities as far as I'm concerned. He has 20 years experience in the energy sector and leads Foresight's infrastructure investments in Europe. Prior to joining Foresight, he worked at Deutsche Bank. And before that, he was an M&A lawyer at Allen & Overy, but we'll forgive him for that transgression in his career. So thank you, gentlemen, for chairing panels. Can I now turn to you, Carlo, and can you kindly introduce the members of your panel? Welcome, Carlo.
Thanks a lot. Thanks a lot, Marco, and thanks to Inspiration, and thanks for having invited me to moderate this panel. So I'm happy to have as speakers today Giuseppe Gola, CEO from Acea, the Roman-based utility, Matej Letnicki, Head of Transaction Management Infrastructure at KGAL, one of the main German-based infra funds focused on renewables, Luca Matrone, Global Head of Energy at Intesa San Paolo, Giulio Facchinelli, Head of M&A and Business Development for Italy for Counter Global, and then Enrico Lucciola from SACE, member of the new Green Deal products. So I would like to focus our panel mainly on some new key trends of the Italian renewable energy markets, but I think not Italian only, because what we are now experiencing is that many new greenfield onshore renewable technologies are no more supported by an incentive scheme, and many of brownfield onshore renewable technologies are approaching the end of their incentive life cycle. So this factor combined with the new presence in the market of traditional utilities, oil and gas majors is going to lead to a new paradigm, I would say, in the competition scheme in this market, because on one side it's important to understand how to catch value generated from cash flows mainly based on a pure merchant component, merchant risk, and on the other side there is a new presence in the market of somebody, traditional utilities, oil and gas majors, very much focused on leading the energy transition. So I would like to start from Giuseppe Gola, the CEO from Acea. As I said, Acea is the Roman-based municipality. I thank him a lot to have accepted this invite. And I would like to ask to Giuseppe how traditional utilities are adjusting their business model to the complexity of the renewable energy market, and how you think, Giuseppe, traditional utilities can become the new renewable energy market leaders, which are their main genetic, I would say, competitive advantages versus traditional financial players, and what will be so mainly their role in the next future in this specific market. I also know that you are now managing one of the main one of the main transactions in the market, so I know that you know very well the renewable markets in Italy, and not only in Italy. Giuseppe.
Thanks, Carlo. Thanks for the invitation, and also for the fact that you say that I know very well the market. So this is in reality something that I am getting day by day, because I have to say that we are managing this business in Acea, but historically Acea has done some in and out activities in the renewables, and mostly in the photovoltaic business. So we have restarted the development of the photovoltaic less than 2 years ago, and so now we are understanding on a day-by-day basis what could be the role of a multi-utility. So I can share with all of you this experience, and I have to say that day by day we are understanding that there are a significant number of advantages in developing this business in a multi-utility, beside that in other operators or other funds. It's clear that the business, the renewable business, and the photovoltaic specifically is evolving, is developing, is in an important phase of development, and is changing. So it's very important to take into account this. Just to make a little history of this business in Italy, we have passed through a phase in which the level of public subsidy to this business basically transformed this business from an industrial business into almost a pure financial business. So it's clear that anyone with a certain availability of of cash tried to enter into that business because the return of a photovoltaic plant with incentives at the level of incentives that we had in Italy in that phase was so high that probably efficiency and effectiveness in the development was really a nice to have, but not something needed to be a big player. Then we were in a phase of no subsidy and also very limited interest given the potential return of greenfield plants. So basically, for some years, new developments in Italy were almost almost blocked. Now we are in a different phase. So on one side, there is a strong push also coming from the targets of energy to be produced from renewable sources, from the targets that the country has, that clearly is pushing in the direction of increasing significantly the development of new plants. On the other side, the cost of technology has now brought the investment to an interesting return, even with no subsidy, but in a situation which is totally different from what we had years ago with subsidies, because the volatility of the price of energy and the COVID clearly gave us a strong lesson on this, has brought to a situation in which a financial operator is not a perfect operator to develop renewables in Italy in this moment, and photovoltaic specifically alone. So clearly, on one side, for what concerns the utilities, the advantage of being an industrial operator are quite clear and also easy to understand. It's clear that we are able to manage projects with an EPC approach, which clearly is part of our normal way of normal business. On the other side, clearly we can apply important scale and a scale approach in the size of the development that we are ready to put in place, and for several reasons we can exploit synergies inside the group, which on one side I think it's not necessary to have, but on another side is a way to hedge also some risks and some volatility of the market. First of all, the most important level of hedging that we can think in managing this business is on one side the possibility of developing a PPA, a PPA internal to the group, which, because just for the example of Acea, clearly we are short of energy because we have a commercial area which in this moment sells much more energy than what we produce, what we generate. So clearly we are a buyer of energy. In this situation, it's clear that the possibility of increasing the amount of energy generated through renewables is a strong advantage, also because in this moment, and this is a specific example of Acea, just 1 week ago we have launched the offer for new customers of 100% green energy. So clearly now we have to certify that to our customers we sell 100% green energy, and so on the other side, if we are able to generate green energy, this is a strong advantage for us. If we compare these all these advantages, which are quite easy to understand, with the situation of totally different operators, clearly the extreme situation on the other side is a case of a fund, financial fund, but also infrastructure fund that in this moment are very much interested in the development of this business, not because of the business per se, but much more because there is in this moment, it's very difficult to invest money. There are the financial markets, the bond markets are basically at zero return. And if you have availability of cash in your accounts, you have even to pay to maintain cash in your account. So there is a strong need of investing money. And it's clear that this is a possibility, because clearly there is an expectation of significant investments to be deployed in the next years. But on the other side, a pure financial operator does not have all the know-how and also all the advantages that a multi-utility could have to develop this in the best way. So for this reason, I think that we are much better positioned in a much better way. What we are doing, and I thank Carlo for having anticipated the fact that in Acea we are in a phase of we are working on a transaction, potential transaction on the photovoltaic business, which is from my point of view an exact synthesis of what could be the best solution for managing this business in the next future. On one side, we are all the characteristics to develop as much as possible photovoltaic business. On the other side, on the balance sheet of Acea, this development could impact on a way which could change the structure of the balance sheet. I'm not saying that could be a mistake or right or wrong the decision, but for sure, if we go in the development of 1 gigawatt of photovoltaic, we change the picture, the structure of our balance sheet. And this is something that could not be a good news for our investors, because we are perceived as Acea as an operator strongly regulated, so with investments that are focused mostly on regulated business. So for this reason, now we want to develop photovoltaic as much as possible, but on the other side, we are looking for a financial partner, which has to be as much as financial as possible, because we are ready to share the level of investment with this financial partner, to share the return up to a certain level with this financial partner, but on the other side, to retain all the industrial approach of the business, so the capacity of development, the capacity of managing the business, and the risk of price of energy. As I was saying before, basically putting in place PPAs with Acea as a buyer of energy. In this way, clearly we are able to reduce the consolidating these investments from our balance sheet. We are able to reduce the impact in our balance sheet, so the impact and the increase of net financial position. But on the other side, we have all the flexibility to develop as much as possible, and all the risk and opportunities to retaining all the industrial management of the business. So this is the idea. We are working on this deal, and if it's possible, we are ready to close this deal before the end of the year. I think that Carlo, if you I don't know if you have specific questions.
Thanks a lot, Giuseppe. I think we can leverage on some key points that you mentioned in your speech, and thanks a lot for that. I would like now to have a question to Matei from Kegal. Again, trying to leverage on some points touched by Giuseppe. Mainly, Matei, traditional utilities seem to me to have some key and quite unique advantages, because they can think, they can act as a general contractor, as an asset manager, as an O&M operator, and they might benefit and take advantage from a sort of natural hedging. So all factors that might not be in the pockets of a traditional infra funds as you are. or an investment fund focused on renewables as you are. So considering that the category that you represent so far have been used to apply discount rates to future cash flows, mainly composed of feed-in tariff schemes, and now again we are exiting from that soul culture at least. So how the category you represent is thinking to adjust their business model to this new dynamic in the market, to continue leading the market, because I suppose that's your main goal. Some of your competitors, always investment funds, are thinking to or are now structuring strategic partnerships with utilities, by way of example. Ardian just made a public announcement with A2A in Italy. So what's your viewpoint on that?
Well, first of all, thank you, Carlo, for the invitation. I'm pleased to participate and to provide a bit of input from KGEL's side, being a German asset manager. So in a nutshell, what Giuseppe is pointing at, quite honestly, sounds like a fair value proposition for a financial investor. First of all, but well, the reality is it is not easy. It is always, you know, you have to really exactly know the cookie, define the cookie, and divide the cookie into fair shares. It's true what you're saying. We're coming out of a world from the old Conto Energia or other feed-in tariff schemes throughout Europe, where, as Giuseppe was pointing at the beginning of his speech, the industrial play turned into a financial play back then, and this has kind of revamped now. We are going back to, we need to understand as a financial player the energy markets per se. So the old hockey stick game is over. We really are, because we are exposed to merchant risks, which can materialize in very short term. So this, well, you could call it like a fixed income product back in the days, at least for solar. That is a bit over, and we need to adapt, and we need to see where we are standing. And we need to analyze the markets, understand the transition, and also going forward what the regulatory framework is setting out in terms of enabling financial investors to continuously stay in the game. We have educated our investors from being very passive, like stakeholders in those renewable assets during the last 15 years or so, now to, let's say, take partially entrepreneurial risks, share it with us as asset managers. And we continuously, clearly, are also reaching out or seeking to reduce these risks on our end by creating certain, let's say, fencing and getting more stability into the products. That, amongst others, can be contributed by entering into strategic or partnerships with stronger utilities, or let's say with players that are more experienced than we are in these markets, in these energy markets, and that can, let's say, procure their services in the whole value chain, from development through construction until the long-term operation of the assets. So this is clearly something that we are considering. And the big question then still remains, what is the right place and what is the right kind to invest for ourselves, or where is the place for a traditional fund in these very dynamic and volatile markets, if you want so. So the answer is clearly you have two chances. Either you you anticipate this by going down with your requirements, you accept the volatility and put it into the framework of the fund, or you just adapt in a way that you enable the funds to be more flexible, always with the, let's say, disadvantage of being a fiduciary. It is not your own money, so you really need to clearly define the strategy going forward for the investments. We see this evolution in the market since, I'd say, now 4 or 5 years or so. We see clearly a price increase, fierce competition in the markets, also due to the fact that capital costs have gone down. There's too much money in the markets, all these topics that Giuseppe just raised, and that is well understood and clear to everybody, I think, here in the panel. We have found a way to, let's say, for us as a fund to create a quite flexible and broad mandate in order to be more reactive, to get more freedom of taking investment decision, be it by partnering with stronger players, industrial players, who just support the investment phase during development and going forward to construction and operation, or by ourselves entering into cooperations with developers / sponsors and supporting, financing their development ventures, and then clearly having the freedom to decide on our own how to utilize these positions in the markets, be it in the solar side in Spain, Portugal, and in Italy, which is a strong footprint for us for the time being, or speaking about wind, mainly in Scandinavia and Poland, where we are quite active as of today. So, coming back to your initial question, yes, we appreciate and we see the evolution that, let's say, in the industry is teaming up with financial players. So it's interesting to hear what Giuseppe is saying about the current deal that he's contemplating. And we are in discussions with several of those players. Again, it's not easy when it comes to details. That's a natural fact, and it is one. Let's say it is one possibility again to, let's say, hedge your position by partnering with these players. The other way is again going south in the value chain and taking own risk on the fund level, and then having the ability and the mandate to also sometimes suffer for years, as we did in Italy. Now, fortunately, it turns out that some of our projects, which also been in litigation, are now getting through, and then we will be able to get it started in due course, which is great. And we also do, like in Spain, we see that things just take longer. Sometimes not as easy to explain to investors that they need to wait, but at the end, I think the result will be worth it. That's what we currently see.
Thanks a lot, Matej. I think what you said is what we are now experiencing in the market from financial investors, as you are either trying to enter into strategic alliances, partnerships with the industry, or trying to go south in the value chain, as you said. And trying to go south now in the value chain, I would like to ask to Giulio Facchinelli, Head of M&A and Business Development for Italy at Counter Global. Counter Global, at least to me, seems to be a global developer and an IPP that so far it's quite south, let's say, in the value chain, using the same words used by Matej. Giulio, having consolidated a few giga portfolio and having a long-term prospect for its investment. So on the paper, It's neither a traditional utility nor a pure financial investors, but it's a mix, let's say, of an industrial and a financial approach, which is probably where pure financial investors would like to be by going south in the value chain in the next future. So by being, if you agree with what I'm saying, on the paper, well placed to lead this market, which are the main drivers, Giulio, that will drive you in this market in the next future, a market where the merchant component will be prevailing somehow to incentive scheme, or will be at least to be mixed and blended together with the incentive scheme.
Thank you, Carlo, either for the invitation and for the question. Yeah, you quote the nature of Control Global correctly. Control Global is essentially a global IPP. We own a portfolio of more than 6 gigawatts spread around the world, from Africa to US. And the cross technology, because we own thermal plants as well as renewable energy plant. One of the key drivers we have for our investment, and it is what allow us to be ready to invest either in Europe or in a more exotic place, is that we have some pillars for our investment that needs to be matched in order to make sure that the investment will meet our risk return profile. We need essentially a downturn protection. It doesn't mean that we need a feed-in tariff to create our return. It means that we need a way to protect our capital. So, in other words, it means that we are open to different kind of solution, and we are able to price it according to the riskness. But essentially, in Control Global, at least today, a pure merchant investment probably would not meet the requirement. We are oriented in blended solution that for sure could help us in increasing the portfolio in Italy. The key point is that the potential downturn has to be at least controlled. I don't know if I have been clear, or if you have any further question on that.
Thanks, Giulio. I think the approach from a global IPP, as you confirmed, might be very much competitive in this new market. I think you represent a category of investors that will be key players in this market for all the reasons that you also mentioned in the new future, and they probably might go even more south in the value chain. By which I mean probably also trying to cover downstream. That's my personal impression. Try now to shift from the equity to the debt. by trying always to follow the same angle, Luca. You are Global Head of Energy at Intesa Sanpaolo. You have a very consolidated experience in the lending activity in this specific market. I anticipate, Luca, my main question, I think what the market won't understand now is whether you lenders, and you represent probably the main, or for sure one of the main Italian leading lenders active in this specific market, whether you are ready to finance projects, refinance assets where there is a strong or even a pure merchant component that might be mitigated by short, mid-term PPAs, but you know, here there is some conflict between sponsors and lenders, because the longer is the PPA from the sponsor's perspective, the worse might be. On the opposite side, from a lending perspective, the longer is the PPA, the better might be. So the point is, where's the trade-off? This question also is combined and should be combined with the question then I would like to ask to Enrico, but somehow I would like also, Luca, you to ask to this question, because the Green Deal product structured by SACE, so the counter guarantee provided by SACE to financing banks as you are, might, by de-risking your position mainly, allow you to finance, trying to compare apples with apples, the same projects partially or entirely exposed to some merchant risk, for better conditions, looking at this point from a sponsor's perspective, which I think is the perspective we should have, because I think sponsors drive the market mainly. So, Luca, what's your view on this mainly? How you think you might approach the lending market in the next future, considering this specific dynamic, above all in a country as Italy is, where we do not have so much offshore, which is still incentivized, but we will have many onshore solar that will be not incentivized. So a position on this point, I think it's key for the category you represent.
Okay, thank you very much, Carlo, for the question, and obviously for the invitation. Thank you to you and to Inspirazia. Basically, let's say that if we consider that we have basically 70 gigawatt that we need to add to our installed capacity by 2030, according to the targets of the Green New Deal. That means basically 8 gigawatt per year for the next 9 years. You know, even if we consider and we assume that the FAIR 1 will be extended and the capacity, the incentivized capacity not allocated as far as now, or FAIR 2 will be enacted, obviously a big chunk, a big part of those 70 gigawatt needs to be done in the so-called grid parity. Now, we are seeing in the market, notwithstanding the fact that Italy is lagging behind other markets like Spain and the Nordics in terms of development
development of PPAs. We are seeing several contracts that were signed in the last few months, not only from traders or integrated players, but also by a few corporates. And also the PPA market, I think, is slowly and progressively increasing. And this is an important point because the possibility to fix the price or to have some sort of combination of fixed and variable components, with profit sharings, with cap and floors, and so on and so forth, obviously give up a mitigation in the merchant risk. Now, going straight to the point that you raised, if the question is, do you expect that the banks will be ready to finance full merchant, so without PPA, without PPAs, without incentives? The answer is, in my humble opinion, for the time being, we are not there, absolutely. So I don't see that in Italy, notwithstanding the fact that in some countries, like in Spain and also in some Nordic countries, we have seen a full merchant financing. I don't think that this is something that will happen soon in Italy. What we can do, we can do a merchant component. We can add a merchant component, and therefore we have done it, in many geographies. So we can have 20-30% of the production that is merchant, and 70-80% that is sold through PPAs. We can have 2-3 years of merchant tail. So you can have a combination of basically of PPA and merchant risk that can be combined. Now, if in the future the merchant risk will be embedded in the projects that have to be, obviously here I'm talking of asset-based financing, because let me say one other thing. If we look at transactions where you have a share or you have another, integrated energy players with very solid credit metrics, obviously you finance with recourse on the sponsor, and so there's no problem. So with the asset-based financing, we need in a certain way to mitigate the merchant risk. I cannot exclude that in the future something may happen, because this is the trend that is happening in several geographies. Obviously, if this is the case, the amount of the debt will be significantly less, compared to a situation where you have incentivized revenues or PPAs, because you will probably do the debt sizing on a lower market scenario, and probably you will also need to have a certain flexibility in the amortization profile. So we do full merchant financing. We decide that we take the lower case of a market advisor, and then if the prices will be better than what expected, this will not be the let's say additional cash flows will not be only for the sponsor, but need to be also for the debt provider. So if you need to add some cash sweeps in the scheme. I think that this kind of transaction maybe consider. We are not yet there in the Italian market, but in the future maybe this is something that can be explored. Another thing that we are seeing, and then I close, that we are seeing in other geographies is more to have you know, some mini perm. You have basically the debt sizing on a notional tenor that is, you know, 15 years, 18 years, 20 years, whatever. But then you have a legal tenor of 5 years with a PPA of 7 years, for example. You have a legal tenor of 5 years and PPA of 6 years. So this kind, obviously, there you have a refinancing risk on the balloon, and the size of the debt need to be, let's say, proportionate to the value of the asset. So the level of the debt will be lower than usual situations. But those are kind of stuff that we are also seeing in other geographies. So you know, to close, I think that everything can be discussed with certain flexibility, but with some, let's say, key points that need to be taken into consideration. Thanks.
Thanks a lot, Luca. I'm receiving some questions. Luca, one I think is for sure for you. For an Italian bank of the scale of Intesa, when do you feel comfortable in lending on an SPV basis to a merchant plant? 20–30% merchant, or can you accept more? I think you already answered this, but...
Well, for now we are using 20–30% as a ballpark figure, but again, those need to be assessed with the project. No, it may be also higher. For example, we just closed a transaction, the Renewable deal with Engie, where there was a different situation. We had, I think, 50% merchant there, but you know, it depends on the specific situation. So.
Yeah, thanks a lot. Thanks a lot, Luca. And I think you naturally bridge to my next question to Enrico from SACE. Enrico Lucciola, you had political risks as SACE, and I know you are a key member of the new Green Deal product, which, as I said, if I'm not wrong, it's a counter guarantee by which you take 80% mainly of the project risk. So mainly you the risk by 80% the position taken by the financing bank, making the front runner towards the project owner in non-recourse project financing. Now, I would like, Enrico, from your side, if possible, to understand from your perspective whether your product, which is becoming now quite known in the market, to what extent you think might help the lending market in accepting to take more merchant risk in their financing schemes. I think this is a key point for the market right now. So that's my question to you, Enrico.
Okay, thank you, Carlo, first of all, for inviting SACE to this very interesting panel. It is always a good thing to share know-how and way to structure these kind of transactions. As you correctly said, basically SACE in the context of the Green New Deal, which was launched in Italy under the so-called Decreto Semplificazioni, can provide a financial guarantee covering up to 80% of the senior debt in favor of in the context of this kind of transaction in favor of an SPV. I thank Luca for the very clear and deep picture he provided on the way Intesa, but also Italian lenders in general approach right now the risk of the merchant risk in the context of renewable power transactions, because this is more or less the same story we have seen with almost all the lenders involved in this context. Basically, here you have a trade-off, Carlo, because SACE, thanks to the backing of the Italian Republic, allows the bank to zero-weight the portion of the financing which is guaranteed by SACE. So basically, for the guaranteed portion, the bank do not see the project risk, but has on its balance sheet an Italian Republic risk. So this is clearly an advantage to the bank in terms of risk weighting of the financing, but also for the borrower, because there is an advantage, hopefully, in terms of pricing, because of the lower level of RWA required by the banking regulation, but also thanks to the way SACE evaluates the renewable projects, because while assigning a transaction rating, we do consider also the benefit of the project on the environment. And clearly, a solar power project provides a material benefit to the environment in terms of prevention of CO2 emission in the atmosphere. Having said that, the impact of the SACE guarantee on the percentage of revenues of the projects which bear merchant risk will depend clearly by the also from lender to lender, because clearly we can take a major portion of the project risk, but not 100% of the project risk, because here we do have to comply with the European regulation on state aid. So basically, we can go as far as increasing the percentage of merchant risk as the lender is willing to take on the 20%, which is not guaranteed. This is basically the answer. From a SACE perspective, I just want to point out that we are looking several projects in notably PV projects with an important portion of the revenues deriving from a PPA. We, as an institution, would like also to consider structures with shorter tenor PPAs, so tenor below 10 years, which is pretty standard on the market, but also projects without any PPA, because we have seen that in other countries, as Luca also mentioned before, this has been the evolution of the market, starting from PPA and going ahead with a higher portion of merchant risk, and possibly to go evolving to 100% merchant. So, as also Intesa has pointed out, the quota of merchant risk in the project will have an impact on leverage, so the debt to equity ratio of the project, because clearly a project with a higher portion of merchant revenues will have to have a more cautious and conservative structure. And also on ratios, because clearly on a project which is exposed to the evolution and the trends of the market price, as we also have seen last year with the pandemic, which had a deep impact on the merchant price of electricity. Really, we need to have a project able to stand material downside of the electricity price for pretty long periods of time. So basically, the more merchant risk there will be in the project, the more cautious and conservative will be the financial structure of the transaction. But in principle, as far as there is a bank willing to take the same risk as SACE, we are ready to consider also structures more aggressive in terms of merchant risk. I hope I clarified.
No, thanks. Thanks a lot, Enrico. And I need to say I'm receiving questions about this last topic, which seems to be of high interest for many of the attendees. And among the questions, I would like to ask probably to Luca, I think might make sense, whether you think that energy future forward contracts in the energy market might be a solution to secure fixed income and allow any way to finance always merchant-based project. I have another question, which is mainly the same.
Yeah, if you want, I can take a couple of questions I'm seeing that are.
Yeah, exactly.
So basically, for the first one, the point of the futures is that the Italian market is liquid for the next 2-3 years. Better 2 years, because in 3 years is already starting to be not liquid. So this is the point. If in the future we will have more liquidity in the market, will be a different story, but this is not the case. And so this is why the PPAs are needed, no? Because if not, we will hedge basically doing a derivative in the market. For what refers to the DSCR, I'm seeing the last question is 1.3 for 1.2, 1.3 for regulated revenues or PPA, 1.8 for merchant. And then I've seen another couple of questions.
Sorry, Luca, just not to create misunderstandings. When you say 1.8, you are assuming a mix between merchant by which merchant might weigh 20-30%, or merchant only?
I mean the 20-30%. So the merchant component, the revenues, and so the cash flows are related to the merchant component need to have a DSCR of 1.8. The regulated revenues, and so the cash flows are 1.3, 1.2, 1.3. Okay. And that's it. I don't know. Then someone was asking if is expected to have other incentives in Italy.
No, one. I think the answer is quite pronounced, but it should be yes, of course. What is the interest of financing the new projects coming off the ongoing auctions, where, I mean, you have 20 years feed-in tariff? I think the interest is very high from your side.
Absolutely.
And then the other question have been already answered. Will the PPA market be enough to hedge the required exposure?
For the time being, yeah.
Yes. One question I would like to ask to either Giuseppe, Mattei, or Giulio. So what's your feeling about what, from your perspective, should be the expected returns on equity for fully contracted projects versus merchant projects in the current market, if you have a view?
Well, it really depends case by case, and also it depends by the the kind of investor. For instance, in Control Global, we have a scale economy on the insourcing of O&M and a good access, I would say, to the financing markets, so that probably our internal IRR is a bit higher, but if you compare the price with market standard assumptions, it turned out to be very low. So I don't like to speak about IRR, because you should know all the background. Otherwise, just a number.
Yeah.
Agree, Carlo. I think, you know, IRR always is a fact.
It depends how you calculate.
Exactly. You need different factors, and everybody is calculating a bit differently, so it's very hard. And I see there are more than 200 people in the panel, so I think it's very hard here to throw figures. I don't want to, you know, in terms of expectation management, everybody needs to take its fair view. So yeah, that's my answer.
I personally agree on that. So it's key now in this new market for on the sponsor side to have a clear view on that specific point, and to set a well marketing strategy based on the view that internally is going to prevail, let's say, around this topic. I'm reading now one question, Enrico, which is for you. So how should access to such a guarantees be managed? Through the lender or directly by the SPV sponsor?
I mean, the two approaches are both good. Basically, in case a sponsor approaches such a first, then it will have to, let's say, syndicate such a facility with a banking, with a bank or a pool of lenders. So, on the other side, if Sasha is approached by the lenders, then there will be already a pool in place willing to finance with a certain portion of the financing covered by Sasha. So we can work in either ways. We have seen transactions where Sasha has been approached by the sponsor directly, and other transactions where Sasha was approached by the lenders. No preference in this respect.
Thank you, Enrico. I think that's a key information for the market now. So I'm reading other questions, but I think we are running out of time. So some of them are very interesting, but unfortunately, I think we do not have time to ask them to the speakers, and so to give an answer now to them. So let me thank you again, all of you, Giuseppe, Mattei, Giulio, Luca, Enrico. I think you provided a very valuable contribution to this panel around a topic that I think it's a key topic now in the market. And for sure, there is no final answer to that topic right now, but we'll see how the market will develop and the dynamics will be created around this specific topic. I thank you again, Inspiration, for having allowed us to have this panel. And I want to thank you also for having allowed me to moderate it. So thanks to all the attendees as well, and I will leave, I don't know if there is a break or if I need to leave the floor to Federico from Foresight.
Thank you very much, Carlo. Very interesting panel. There will be a break, so just 10 minutes to make some coffee, and we will be back with panel 2. Moderated by Federico Gianandrea from Foresight. So thank you again.
Thanks a lot.
All of
Thanks
you.
to everybody. Bye bye.
Thank you. Thank you. Bye. Bye.
Thank you.
Thank you.
Bye.
Welcome back, everyone. I hope you had some time to make some coffee. So after the first part of the conference, a great panel by Carlo, thank you again very much for it. We're moving to the second panel of the day, creating financing solutions for renewables, which after in panel one, we discussed about new innovations and challenges, how we overcome challenges in the financing side of things. We will dig more into this with the session to be moderated by Federico Gianandrea. Everybody knows, but Federico is a partner at Foresight. He leads Foresight's infrastructure investments in continental Europe, and he also leads the business development for infrastructure globally. And he's actually based across 3 offices: Rome, London, Luxembourg. So quite some variety of experience there. I'm really looking forward to the session. The floor is yours, Federico.
Thank you, Maritina. Thank you for Inspirazia for organizing the event and inviting me. Before I start, I would also like to thank all the panelists, which I'm going to introduce. I don't know if you guys can, in the meantime, let's say, open your camera, therefore you can be seen by all the attendees. So today we have Tommaso Gazzelli, which is the Finance, Mergers and Acquisition at Total Holding, Francesco Cacciabue,
the portfolio agreement,
and CFO.
you've got a sort of partners position in terms of
somebody.
Goodwin and IQ.
I don't know if we have some issues in terms of interference. Apologies for that. Then we have Alberto Cei, Regional Head, Global Infrastructure and Project at Natixis. Giancarlo Giudici, who is Professor of Corporate Finance at the Department of Management and Engineering at the Politecnico di Milano. And Enrico Orsenigo, Managing Director at Bay Green. Once again, before starting, let me wish a happy birthday to both Enrico Orsenigo and Alberto Cei, that obviously have spared an hour of their time today, despite being their birthday, to be here. That's how much they commit to, let's say, the renewable market. Let me.
Thank you, Fede. In the meantime, if you can actually open up my webcam, because I think it's blocked by your host. There is a blackout in Milan, so we had a little bit of an issue with the power since we're speaking about energy.
Oh, it's blocked for everyone. It's blocked for everyone.
Okay, for the people in Milan, it's blocked. Anyway, thank you very much for your best wishes, and happy birthday to my friend Alberto.
Pleasure in doing so. So before we start, just wanted to set a little bit the scene for this panel. I think as players of this market, we see that the renewable landscape is ever changing. There's ever increased competition. We've seen that lately both oil companies and utilities have come incredibly strong in this market. That has created an incredible yield compression. We're transitioning from the subsidized territory to the unsubsidized territory, and we are experiencing more and more an industrialization of the sector. And the combined effect of this element calls for a new, creative, cheap, and efficient way to finance renewable. So today we will hear from our panelists the point of view of equity investors, both industrial and financial, financiers, market analysts, and to try to understand which are the new needs and the trend of this ever-evolving market. I don't know if you guys want, starting from Tommaso, give just 30 seconds introduction of yourself in order to present yourself to the audience, and then we'll kick off with the questions. The idea is to make this as interactive as possible, so we try to be short and be in the 40 minutes and leave probably 15 to 20 minutes for questions at the end.
Federico, it's a pleasure to be here. I'm the head of finance and M&A in Toto Group, and also I'm in charge, of course, of the activities of Renexia. We are proud to be part of this panel with this remarkable partner. Renexia is a pretty newcomer into the market, but in the last 3 years we have been expanding our activity. So again, it's a proud to be part of this fund. Thank you very much.
Enrico?
Sorry, I'm just unmuting myself because again, I said I was on the mobile. Thank you very much, Fede, for hosting us. Thank you very much to Inspirazia. Very Green, it's an equity investor, but we all have a kind of a debt background, and I was formerly a banker, so pretty much into the financing story. And in the latest 10 years, I've been operating with equity to brownfield, greenfield, and also NPL in the latest days. So I think we can actually have a good debate on the day, and hopefully going through all the items and the discussion we're having on the board.
Francesco?
Thank you, Federico. Francesco Cacciavue, Glenmont Partners. I'm the CFO, one of the 4 partners at Glenmont. Glenmont is manager specialized only in renewable energy. We manage 2.2 billion. Thanks.
Giancarlo?
Hi to everyone. I teach corporate finance. I work at Politecnico di Milano at the School of Management. And I am also the director of 2 observatories, one on mini bond and the other one on crowd investing. And we study the financing of SMEs and actually in the last years also the impact of sustainability on the financing.
Last but not least, Alberto?
Hello to everybody. I don't know if you can see me. I'm Alberto Cei. I'm a managing director and head of real asset in Natixis Milan. Natixis is a French bank which started finance renewables several years ago. And I think it's a pleasure for me to be here to exchange a bit of experience and to see a bit what is the trend of new financing products in this sector with you guys. Thanks a lot.
Thanks, Alberto. So starting with the questions, I will start with you, Tommaso. Your group is very active in the market, and you recently completed 2 large transactions where you used 2 different types of financing for your projects. On one side, the classic project finance. On the other side, the new project bonds. Can you please explain us briefly the reasons for the choice depending on the 2 projects, and what are the main differences between the 2, and what are the challenges of this, let's say, form of financings?
Okay, thank you for this question, Federico. You are right. We are, of course, on any project, we are going to explore the various opportunities on the market. We are mainly an EPC contractor, even though we are also an owner of the project. And in the last couple of years, we also modify our business approach, because in the past we were more interested to sell the project after completion, while now we are keen to maintain the project in our portfolio even during operation. Of course, the leverage and therefore the financing is the instrument on the market is a very important key element of our business model and investment decision. Because being not a financial counterpart but an industrial company, of course, we have a limitation in investing equity into the project. In terms of selection, we did 2 we believe a pretty important transaction last year. One, it was in an offshore, I believe the first offshore project in Italy, in Taranto, called Belleolico, 30 megawatt in front of the port of Taranto. It's a pretty famous project. And the selection was to have bank financing, by the way, together with Alberto. I mean, the reason of the selection was not mainly based upon Alberto, but based upon what the banks offered, of course. I have to say that the most critical issue of that project was the technical part, because it's a pretty specific project with, it's an offshore project, which is again the first one in Italy. It is close to the shore, so there are technical issues to be solved. And on top of it, as we had, as other players in the market suffered the problem of the Symbion issue, we had to modify the suppliers of the turbine. We selected a Chinese supplier, so it is the first project in Europe with this supplier. For those kind of issues, it was more convenient to approach a bank which have, in my opinion, more sophisticated approach and capacity to understand also the technical solution of the project rather than the capital market. While for another project, 35 megawatt onshore in Campania region, which was much more standard, with the turbine provided by very reputable supplier like Siemens Gamesa, we did the choice to select the project bond solution, and the reason was mainly driven by the gearing, because we obtain on the capital market a pretty attractive condition in terms of debt sizing, which driven the gearing to 90%, so a very high leverage. That reason for us, that issue is very important, because as I said before, the equity component of a project for us is a very important issue to take under control. So that was this choice, the selection is made on project on case-by-case basis. But I have to say that today, as of today, if we have a standard project, we prefer the capital market solution, because the debt sizing criteria are a little bit more attractive of the banking system, even though I have to say that in terms of cost, the banking solution is still a little bit cheaper.
Thank you, Tommaso. Very clear. Enrico, so we heard from Tommaso what is available today in the market, but you, as an innovative equity investors in the renewables, dealing with development, construction, and secondary market transactions, can you please tell us what are the new needs for the investors in this climate?
Okay, well, I'll start, with the kind of easy answer, which we heard in the panel before, which is, of course, there is financing available for greenfield, which is the, I don't know that, how can I say it, but the latest trend. So now it's becoming of fashion about greenfield developments as well. So the famous concept of merchant risk and how to approach merchant risk. From one side, I tend to understand how the financing market is, let's say, sticking to the principle of having the DSRRs and all the concept of trying to hedge as much as possible the merchant risk. On the other side, this strategy could apply only to certain type of projects, which actually are capable of mobilizing a level and an amount of debt and equity, which actually gives a reason for structured finance approach. Whilst, as you were saying, the kind of approach that we are using, which is a little bit more different, which is building from scratch smaller projects, on one side doesn't make any sense to mobilize single financing of, I don't know, 5 to 10, 15 million euro. At the same time, we are placing ourselves in the middle of the chain. So in the development and construction business, for example, we're not going to be long-term holder of the project. So what we really would like to explore the market for is having a kind of working capital or construction revolver facilities approach on the project that we are developing. We are building and constructing with our own funds, but in order to, let's say, make it more efficient, we're not looking for high gearing, we're not looking for high leverage. We just wanted to optimize the process, because of course, if we have to deal with a number of projects being built at the same time, and with a number of pipeline projects being permitted from time to time, it's a lot more efficient having from a return point of view debts, but at the same time having a kind of more structured approach. So I think that the market is totally new there. It's an unknown territory, and I think that probably in that particular area, the banking market will be more receptive rather than the bond market. But it's going to be, let's say, 2021 and 2022 goal for us in order to tap on the market on this particular product. At the same time, another kind of thought that we're having in these days is that we've always been seeing this industry becoming a proper scale industry or scalable industry, and we're seeing many industrial players coming into place in these days with partnership with the financials. We heard about Acea, we're hearing about Edison in the past, but at the end of the day, the kind of, let's say, 5-year or 10-year loop make me think that there's not going to be soon distinction between brownfield, greenfield operating and non-operating plans of development, because at the end of the day, they are going to be sooner or later exposed to merchant risk. There's soon going to be a function of where the market will make the prices moving. So at the end of the day, I think that the silos mentality that we've seen today is going to be kind of replaced by an industry kind of approach, whereby on the equity side, on the debt side, the distinction will be a lot thinner. Like the previous panel, Luca from Bancaini was saying, there's going to be a different approach for merchant rather than regulated, rather than half-regulated or new tariffed project. But at the end of the day, it needs to be a mixed approach. So starting from, let's say, the need that as say smaller kind of player in the development market are today for us, of having a kind of a 3 to 5 year construction revolver facility. At the same time, I think that sooner or later in the following years, there's going to be larger portfolio, which is going to be a combination of merchant and regulated revenues, which suggests me a little bit of let's say, a throttle to the past when we were seeing the first merchant projects in the UK market. I think it was around the year 2000 something, where there was a composition of different tenors for the revenues and then let's say the two kind of offset the merchant risk, so that at the end of the day the SCR approach for banks would be a kind of an average. So there's going to be medium, short, and long-term offtake, which will balance the, let's say, the gearing objectives of the sponsors, at the same time the protection objective from lenders. Again, I bounce the questions to lenders, to lenders, yes, and to see whether this kind of approach may be welcome, or there's going to be a kind of availability in discussing this kind of structure in the following months, because it's something coming straight to the market. Although, as we were saying before, the number of projects being permitted and being built is not as wide as everybody was expecting in the past.
Thank you, Enrico. Going to Francesco, we understand that Glenmont is in the market with two large portfolios, one in Italy, one in France, but then obviously similarities applies in these two markets. How do you see the secondary brownfield market in Italy and France for wind, and how do this financing or refinancing in the acquisition of these assets play a role? And how do they deal with obviously the merchant tail that all these projects that originally were benefiting from tariff and then going into merchant are tackled by those financings?
Yeah, sure. Correct. As you say, Federico, currently Glenmont is on the market in Italy and in France with two large portfolios of wind projects. These are projects that originally we acquired between 2013 and 2015, already in operation at that time. So the French portfolio is around 100 megawatt. The Italian portfolio is around 315 megawatt. So it's actually one of the largest projects on the market since Renewable in Italy. And these are assets that had a mix of old tariffs, some of them with the old green certificates, some of these assets with the auction of the Dutch auction with the prices going down. So it's a mix. Some of them have only something like 4 years left of life. So it's actually an interesting. It's been interesting for us at Glenmont to see how the market is looking at this a bit more obsolete, if we can say in this way, projects compared to other things we see in the market. Until not a long time ago, everyone was focusing on ready to build. And actually, what we can say is maybe 3 main points of interest for the people attending this conference. First of all, we have seen a really strong appetite for this type of asset, even stronger than what we expected, with bidders with extremely low cost of capital. And we think that this is possible because some of these bidders, they must have taken into consideration upsides such as the repowering of these projects, the possibility of adding storage and create some hydrogen solution, as well as some sort of a hybrid power plants. But not last and more close to what we're talking here is the possibility of doing refinancing. At Glenmont in the past, we already done refinancing while we were running the asset. I think we were the first investment house to create a bond for wind projects that were listed on the Milan Stock Exchange. So definitely there's a strong appetite for brownfield, also because of the financing solution, also because there is a series of upsides such as repowering, storage, hydrogen that the players are taking into consideration. Another observation is probably already been covered in the previous session, from what I understand from the initial remarks, is the emerging new type of players. So players that are the utilities as well as the oil companies that are coming into the market. We had many players of this type participating to our processes, and it is interesting like how this player, going back to the previous point, they can bring not only the financial side, but they can bring something like an understanding of the market post incentive period, an understanding of the technology and the way they manage this asset in order to extend the life of the asset beyond the 25 or 30 years. And also the possibility for some of these players, especially the utilities, to have a final consumer. As we know, the Italian electricity market has been liberalized, and so for the other countries in Europe. So these utilities have direct contact with a series of consumers, households. The final point I think is also very interesting is the JV that we're seeing coming between industrial and financial investor. I heard like the name A2A and Ardian previously, Eni, CDP, Edison, F2I. Is interesting, like industrial are matching together with financial players. We don't have direct experience. I would be interested to hear how the other panelists see this type of joint ventures. The way I imagine this joint venture works is because the industrial player is focusing on more the ready to build and development projects, while the financial players is more looking at the cash flows coming from the asset already in operation.
Okay, thank you, Francesco. Very interesting. Coming to you, Alberto, you probably have seen all the financings that have happened in Italy in the last years, and you were involved in the majority of those. Where do you see the market heading towards? What are in the debt investors' point of view in terms of this new risk and how to price this risk?
Yeah, thanks. First of all, I think it's a pleasure for me to stay here because we've been working with more or less all the panelists here. We've been working on a greenfield on the offshore wind transaction with Tommaso. We've been working with the first project bond in the wind with Francesco, and also we are closing a transaction quite innovative with Enrico. So I think it's really a pleasure for me to be here. With respect to the market, I can summarize a bit the market today as follows. First of all, the sector is clearly booming. The renewable sector now is really on top. I mean, everything which is green now, I think is better than gold. So I think for everybody who's involved in the sector, I think it's a very good moment. Second point, there is a very high amount of liquidity in the market. And the third point, especially for Italy, I have to say, is the reduction of the number of traditional banks because of consolidation and other aspects. At the end of the day, the banks acting in the sector less and less. So the result of this is that there is a lot of liquidity which has to come from both banks, but in the same time also to what we call non-banking financial institutions, i.e. the debt investors. And this, I think, brought to the market, as already specified and described by the other panelists, a lot of new products that could be used in the market. And these products actually are to be tailor-made for the specific situation that you might face. I mean, if you are investing in greenfield development, you have some products. While you want to have a global refit, there are other products. Just to mention some of them, and most of them they could coexist in the same transaction. I mean, we did the transaction which in the same transaction it had almost all of them. You have, for example, structured loan. You have project bonds, which now are a reality. We made the first project bond back in 2014. Now I think a project bond is something really normal. Everybody could really do. Then you have a securitization vehicle, and we also did a transaction where a project bond could coexist with a securitization vehicle. Then obviously the acquisition financing in the sector now is a specific acquisition financing which typically goes together with the other projects like project financing or capex facilities. And on top of this, now they're getting more and more popular, the junior or holdco financing or mezzanine debt, and including unitranche, which are new products in the market. And obviously, with all these products, I mean, clearly now I think you have better weapons to try to find financing solution for each phase in the supply chain. As I mentioned, for example, if you have an acquisition, typically you can have an acquisition together with a takeout in a bond, which could be also a green bond. I mean, and which has a very strong attraction in the market. For example, if there is a strong portion of development, now there are products that are also fit for the DevEx, what we call the DevEx, which so far there was not in the market. And for the global refi now, I think it's really easy to put all these products all together. I mean, the point is that the products are just the dress. The fact is to attract the highest amount of liquidity, which comes from local banks, international banks, and various kind of institutional investors. The institutional investors are different, and so effectively we need to try to find the right dress to attract these kind of investors. To answer the question of Francesco with regard to the fact that now there is this kind of strong oil companies, which sometimes they're teaming up with financial investors, equity investors. I think from my personal perspective is definitely they are consolidating the market from one side. My only fear is the fact that maybe they are taking out a bit of the entrepreneurship that there was in this market before. I mean, all of us, I think they experienced the fact that this market has been created a bit from a bottom-up approach. And I hope that this new consolidation, which is bringing a lot of also liquidity also from the equity side, will not change this kind of entrepreneurial mentality of the sector. This is more or less the market. In terms of pricing, that I know that you want to know this, clearly there is now the abundance of liquidity, so effectively the prices could be, depending on the product you have, is a good moment. What we can say, the difference between banks and non-banking financial institutions is the banks, maybe they don't really care about having the Euribor floored at zero, while the financial investors, they have to, because they are real money investors. So effectively, then with respect to the real margin, they are quite similar. This and it depends a bit on the various situation, of course.
Thanks, Alberto. Going then to Giancarlo, I think we heard the point of view of the institutional equity and debt investors. It would be interesting from your side, being obviously heading the Osservatorio di Mini Bond and the Osservatorio of Crowdfunding, from which you have a really privileged point of view of seeing what's happening in the markets. Can you tell us what happens in the SMBs and retail sector? And what are the financing tools that are available today for financing renewables of a smaller scale?
Thank you, Federico. Historically, in Italy, companies relied on bank debt and loans, and only large listed companies had the opportunity to access to security market and to raise money through other channels. But now the situation has changed, and also for SMEs, we have alternative channels to raise money. And I want to focus now on that, and maybe in the second round we can focus also on equity alternatives, on innovative instruments like, for example, crowdfunding. And it's thanks to a new law that came into force in 2013. Today, SMEs can issue also bonds on the market to raise debt capital. And a new industry has born, which is called in Italy the industry for mini bonds. We mean bonds issued by SMEs. Typically, we say the maximum amount to be classified as a mini bond for a bond is 50 million euro, but actually the system, the way it works is exactly the same as the bonds issued by large companies. And this is becoming an attractive new asset class for investors. Now the market is worth about 1 billion euro for all SMEs in Italy. And some of them are also using mini bonds as to finance renewable projects. And Alberto told about the green bonds, and there are also green mini bonds. So bonds issued by SMEs in order to finance green projects or renewable energy projects. What is the reason why this asset class is becoming interesting for investors? The first one is that there is a new liquidity premium. So we are talking about bonds issued by SMEs. The bonds are not listed on stock exchanges. Sometimes they are listed on unregulated exchanges. For example, in Italy, we have a dedicated market, which is called Extra Mot Pro Cube, but they are essentially liquid. And so they can reward investors with a premium compared to the return on the market, given the same rating or credit scoring degree. And on one side, this tells us that we are not talking about cheap instruments, as Tommaso said before, because typically, if you have access to bank loans, the interest rate charged by the bank will be lower. But raising through mini bonds is an alternative source, and there are some benefits for the companies. And some companies are willing to pay a premium in terms of cost of capital when issuing a mini bond. The first pro is that you can differentiate and diversify the sources of finance, so that you are not depending only on one source of capital on one bank. In Italy, we experienced in the last years a sensible concentration in the market for banks, and we have companies that maybe up to 5 or 6 years ago, they were working with 5, 6 banks, and now they are just talking with one bank because all of them have been merged together. And so it's a benefit to diversify the sources of money. The second pro is that we experienced, even thanks to the interviews of our observatory, that issuing a mini bond is the opportunity for a small company to get in touch with institutional investors. So it's like practicing for raising money in the future with more formal instruments, for example, through private equity, or even also by listing on the stock exchange. So it's the opportunity also for the company to gain competencies, to gain new skills and professionalization in managing the finance business of the company. And the last topic I would talk about is that now there is, even thanks to the recovery plan and to the activism by public entities in Italy following the pandemic, there is a strong interest on mini bonds from public investors like Cassa Depositi e Prestiti, or even at the European level by the European Investment Fund. And the mini bonds are also eligible for the government guarantee. There is an instrument which is called the Fondo di Garanzia, which is a credit enhancement mechanism, which is able to guarantee up to 80% for micro companies, even to 90% of the money that you raise through a mini bond. So this is the reason why it is becoming attractive. And also, as Alberto said before, even with mini bonds, we have the opportunity to create asset-backed securities and to engage in securitization. We have the so-called instrument in Italy, basket bond. The basket bond is the securitization of mini bonds issued by several SMEs. We had different experiences in Italy of different SMEs in the same industry or at the local level in a regional district issuing mini bonds, and then mini bonds are bought by a special purpose vehicle. And this is the opportunity to obtain an amount of money which is more attractive for investors. So probably the single issue, which is 5 million euro or 7 million euro, it's not attractive for international investors, for global investors. But if you are able to package together all the mini bonds, and you can create a deal which is worth even 100 million euro or maybe more. So in our observatory in Italy, we tracked about 15 issues by mini bonds related to the financing of renewable energy, and raised 150 million euro. That is a drop in the sea of the financing for the companies, for non-financial companies in Italy, but it's an industry that is growing, and we expect in the future to grow up as well.
Thank you, Giancarlo. Conscious of time, I think we had 20 minutes left. I'm going to have another round of questions, so I ask you to be a little bit quick in answering, considering that we want to answer also some questions from the audience. And I also have to say that Francesco, unfortunately, at 4 o'clock needs to disconnect because of a previous commitment. So thank you, Francesco, in advance for joining us. Tommaso, being an industrial group, you also mentioned before that you're also the EPC. What are the challenges that you face in financing your projects from more from an equity perspective and a debt perspective that you said before? Are there any instruments that you've been using there?
Yes, Federico, of course, we also raised financing for part of the equity commitment by means of holdco financing or mezzanine financing, also mentioned before by Alberto. In my opinion, I mean, for the future, I see space for improvement in the financing instrument. Also, considering what Alberto said before, there is a pretty bunch of liquidity on the market. So from my perspective, the challenge for the financing instrument are different in respect of the instrument. If we are thinking to the loan market, in my opinion, the banks, the traditional banks should be a little bit more in line with the actual condition of the market to improve the debt sizing criteria, because this is the lack, in my opinion, of the bank system in comparison with the remaining instrument on the market. Regarding the capital market, in the future, it would be even interesting to understand if it is possible to raise a public bond, in the sense that for the time being, the project bond is mainly built up by means of private and bilateral discussion with specific investor. In the future, it could be interesting to understand if, in order to improve the conditions, it could be possible to raise also public bond. And for sure, for us, just to complete, because I would like not to lose time for the others, it would be interesting for the future to understand if this is the possibility to raise off-balance instrument like securitization or any other kind of off-balance instrument, because of course one of the constraints is the equity, but the other one of course is the level of debt. Also taking into consideration that in our business model, for example, we are going to maintain for sure the majority of the project, so we need of course to take under control the debt amount, the leverage of the group.
Sorry, I couldn't unmute myself. Thank you, Tommaso. Going to Alberto, I mean, we heard about these new instruments that you guys have been using, and do you think there's any new product there's going to be a breakthrough of something we haven't seen before, or is the combination of the various products blended together which will give the answer to the new challenges in financing these assets?
No, what I believe is that before these products, they were some kind of pioneeristic products to be used, like when you were discussing about project bond was something really fancy. I think the beauty today is that all these products are realities, and at the end of the day, you need to use them in a proper way. Obviously, I just make an example. If you want to finance a solution for energy efficiency, which is composed by several construction companies that are maybe doing a super bonus incentive, something like this. In that case, it makes sense to have a securitization or even a basket bond, as was mentioned before by the Professor Giudici. If you want to have let's say development and construction financing, maybe you go maybe for a unitranche or maybe some sort of junior debt. And I think they are not fancy products themselves. I think the beauty is that now there is a possibility to have all of them. I mean, there is not just the pure bank finance, project finance, and this I think is the main change. I don't think there will be a breakthrough product, because you guys, you are doing the business. I mean, the banks and the financial institution, they are just trying to help support you in do your business. So I think the breakthrough will come maybe mainly from the industrial part rather than from the financial side.
Clear. Enrico, financing obviously renewables implies that you raise the equity in doing so, and in the yield compression environment, what do you think are the new financial and organizational structure that you can use to enhance those returns, and what are the challenges that investors like you are facing in today's market?
Well, we touched upon this just in the past. I mean, the competition of yield compression, it's actually a function of the different actors that we have in the equity markets. And I think it's all related to the placement that each of us as investors want to cover through the chain. So at the moment for us as a mission, we are, let's say, a true equity investors in the entire, let's say, value chain creation, being from development, greenfield, brownfield, and also NPL across energy. For us, I mean, we have kind of embraced the strategy of having everything in the same bunch, I would say. So we try to, with our own capital, try to address it and to create different sub-platforms. So we tend to raise funds for each and any platform because, as I was saying before, the silos mentality is still, let's say, reigning in this environment. What we are aiming at is that we aim again to find some investors who share with us the view of having everything combined in the same box, because sooner or later they all become the same thing. So by having, let's say, an actual differentiation of risks and rewards as well, we could achieve those returns that are required for a smaller player like us. So not having, let's say, the lowest cost of capital we need in order to comply with what is the requirement of the market for us as particular players. We need again to do each and any kind of let's say risk-reward curve investment. Again, the threat, which I think is the most important thing, is to try to push the markets toward, let's say, combining the old products, so that we don't have to, let's say, all of the time raise the different funds in relation to the different cost of equity for each and any strategy. The day that those strategies will come, let's say, all together in the same pot, that will be a lot easier for us. Clearly, the winning point is to be, let's say, more efficient than the average. And in order to be more efficient than the average, again, we need to, let's say, push for innovative products, either on the debt or the equity, as I was saying.
Okay, thank you. Finally, Giancarlo, last but not least, we are all players of this market, and actually each one of us as a private person would like to give a contribution to this energy revolution. So how can we finance our home or small scale projects, or how can we invest in the green economy from a retail angle and in a calculated risk environment?
Yes, actually, this is a very hot topic. Because there is a growing sensitivity in the market for sustainability. Let me tell you, for example, that the Italian version of the European Recovery Plan, which is the so-called PNRR, which is our recovery plan, will mobilize 2.2 billion euro for the energy communities. What is an energy community? The energy community is a local community made up by producers and people, families, and also public entities that they group together and they create an association to produce energy, not only renewable energy, but also traditional energy. And they are meant to create a network so that they produce exactly what they, on average, they need for the consumption. So these resources which will be mobilized are for small towns, for towns in which we have less than 5,000 residents. And the expectations in the Italian Recovery Plan is that there is a new increase for capacity of generation for 2,000 megawatts, which is a huge amount of new energy that will be created. And obviously, since the local public organizations will have a relevant role in this, it's for sure that the production of green energy will be favored. And so we think that there will be a strong increase in the short run for the interest in small villages and families to invest their money in these projects. And one of the instruments that is available for this is crowdfunding. Crowdfunding means we raise money from the crowd of people. And in Italy and also in Europe, we have a brand new regulation that will come into force from November, which is the European Crowdfunding Service Providers Directive. And there will be a unique regulation for raising money through equity crowdfunding and lending crowdfunding in all the European Union. And what is the benefit of investing through crowdfunding in a renewable energy project? There are benefits for investors and there are benefits for the promoters of the project. So let's start with the promoters of the project. First of all, it's an instrument to increase the acceptance of the projects at the local level. So there are some academic researchers showing that if you involve the crowd in raising money for the project and you open a fraction of the equity capital of the project to small investors, there will be a better acceptance of the project at the local level because they will see that there will be some benefits for the local community. Then it's an opportunity for democratization. Typically, if you want to invest into renewable assets, you have to spend a lot of money because maybe you can invest in your own project. You can put photovoltaics on the roof, or you can find a hydropower project or a wind farm around, but you have to spend more money. With crowdfunding, you can invest even less money because your contribution will be added and accumulated together with many other contributions. So it's a way to give an access also to small retail investors to a new asset class that historically has been accessible only for professional institutional investors like green funds or renewable energy companies. And then there is the benefit of risk diversification, and we have also tax benefits. I was answering to a question just some minutes ago in the chat. And in Italy, we have two types of instruments of tax benefits. One is called the PIR, Piani Individuali di Risparmio, which is very similar to the UK version, which is the individual saving account. This means that if you invest into the debt capital or equity capital of an SME, and you keep the investment for some years, you have no taxation on the capital gain, on the dividends or interest. And the second, very interesting incentive is if you have a startup company or an innovative SME which is carrying on a project in the renewable energy, and you invest into the equity capital of this company, you have a tax relief which is 50%, which is up to 50%. According to some conditions, up to 50%, otherwise 30%, which is very good because it means that you have a floor in the losses, because immediately the government the next year with your tax filing is giving back 30% or even 50% of what you invested. So now in our observatory, through crowdfunding, still we are talking about very low amounts. We monitored some companies raising through equity crowdfunding in the renewable energy sector, mostly for photovoltaics or green projects, like, for example, eco-efficiency or installation of instruments to save on energy, for example, for electric cars, or building efficiency, and raised about 6 million euro. And we think that through lending platform, there are no data on this, no public available data, but we estimate that this market in Italy now raised about 10 million euros. So again, it's a drop in the ocean, but still we expect that even thanks to the growing interest of sustainability, Investors want to contribute to the achievement of the strategic development goals. They want to invest in sustainable companies. There is a promising growth for this sector in the future.
Thank you, Giancarlo. I have some questions here on the Q&A, and then I don't know who wants to answer, so please feel free to do so. Is a rating required for the project bond in Italy?
I can answer this question is no. Also because sometimes the requirements of the rating agency are too stringent, and they would be non-competitive with the banking market.
I can confirm our project bond, Federico, 50 million euro was made without rating.
Okay, second questions. We're all discussing about new world of merchant projects. How reliable has been the forward power price projections for the Italian power market? I can answer that myself. It is they never get the price right.
Is any projection which is so reliable in any kind of market? Please.
No, exactly. I mean, it's not particularly Italian one, which it's in my experience, being again a banker on one side and for the fixed and then on equity on the other. I mean, at the end, the power prices, the curves are, an educated guess. I still remember the fantastic name that we had in my previous experience. It was called Crystal Ball, was called the software. So if you have a crystal ball and try to guess what is the price, it's a combination of events that, is related to multi-party. But at the end of the day, I mean, they're proven many times not to be correct. And just to summarize the concept, all of the, let's say, big waves have taken place, but they take a little bit more time, sometimes a longer time than others. I think that, again, it's back to sharing the risk between lenders and equity providers, and sharing the fact that in a market environment for renewables, which is in any case going through market prices and let's say a retail interface, there's going to be positions to be taken. So again, the prices in entire Europe is going to be a function of the new builds. New build is a function of governmental rules and processes. At the end of the day, it's a view there that should be taken. And again, power prices curves are necessary for all of us to approve transactions on the debt and the equity side, but at the end of the day, should be actually looking at with a little bit of kind of reference, but not the key ones. Because if you're lending against those, you're not going to go that far, lending or investing. So you need to have your own idea. That's at least is my view.
Okay, I have another one. Investment returns in a contractor operating projects are trending towards debt cost in some mature markets. Where can investors in Italy expect to find a higher return in this space?
Sorry, you said debt investor?
The question is, investor returns in mature markets, okay, are as such that the gap between debt and equity returns is limited down. Where can investors in Italy, I suppose equity investor, can find high returns in this?
If I may, I'm not the equity guy, but I will try to answer. I think they need to dare to go over the development risk or innovative technologies like offshore wind and other technologies like this. Otherwise, obviously, if you go on a brownfield PV asset with incentives, that one is just a really competition of a few points of IRR.
I agree with Alberto, Federico. From our perspective, the brownfield market is not so attractive because of this very thin gap between debt and equity return. Sometimes it's going to be even negative. So where we can find adequate return is in the development market, in new market. For example, nobody mentioned, I would like to mention the future that could be for renewable energy, the offshore market. As Renexia, we are involved in a pretty big project, of course, in a very preliminary phase, but in this kind of course, new frontier, we can find attractive return. In the brownfield standard renewable market, it's very, very difficult, at least for us.
Okay, final question from Alessandro Cohen, to which I say hello. It seems like we're in the best world possible. Money is chasing projects. All kinds of debt structures are available. Demand for investing in the sector is at the highest level. The only problem is that there are no projects available in Italy because regulators and local entities are against this industry. Any suggestion on how to deal with this?
I can take one portion of it, which is do not throw money at new developers which don't have let's say, a long dated experience. Because I mean, with all this money flowing in the development markets and everybody looking at making returns on development markets, there's going to be option on land priced like gold, and there's going to be optional preliminary connection priced like gold, and this creates inflation on the market. So as a matter of fact, it reduces the opportunity, because then all the authorization body will have a queue of thousands of megawatts to be executed, largest projects, and it will only be complicated. So, I mean, this is a long story in the past history. I mean, at a certain stage, development and construction of projects, okay, we need to ensure third-party access, but it needs to be restricted to people that is capable of doing it in a proper way, because otherwise it would be a second way of let's say, the PV era at the incentive time, and it's going to be you know, creating much more struggles, I think, than results. But again, that's what we're seeing today, at least on our side.
If I can add, Federico, the Italian recovery plan, the PNRR, is promising to reduce barriers and ease the opportunity for private investors to promote projects in renewable energy. But actually, I'm not so confident, because bureaucracy in Italy is very strong.
I agree with you. Well, I think our time is up. We have exhausted the questions. I'd like to thank everyone attending the event, thank the panelists, Inspiration for organizing the event, Marco Dell'Aquila for his kind words in the presentation, Carlo Montella, who didn't thank me before, but a really good friend of mine. So thank you all. Thank you for attending. I hope you had a nice time, and hope to see you soon in another event. Talking about these topics. Thanks again, and have a good afternoon.
Bye-bye.
You too, thanks. Bye-bye.
Bye. Thank you very much.
Thank you very much, Federico, on another great session. Wrapping up the event, I would like to thank once again Foresight and Orrick Italy for sharing their insights and ensuring that so much knowledge was extracted by those two high-level panels. We heard a lot about the current reality of the Italian market, centered around subsidy-free renewables and different investor profiles entering the market, what drives them, what are their requirements, what are the challenges to overcome, and extremely interesting views on financing products beyond the limitations of project finance, and very interesting green propositions for investors to tap in. We are looking forward to publishing the key takeouts from each session, so please keep an eye for those on in the coming days. So closing the session, I would just like to remind all the panelists and attendees to make their submissions for Inspiration's inaugural Energy and Sustainability Awards, set to take place on 28th of October. for which we are very excited about. Categories include Premier Sustainable Investor, Outstanding Lender, Top Legal Advisor, Fund Watch, and many more. So please visit inspiratiaawards.com for more information on criteria and on how to make your submissions. The deadline is 16th of July. The ceremony will take place actually on the first day of our signature subsidy-free renewables and offshore wind summit that is set to take place 28th, 29th of October here in London, where we will talk more about the direction the industry is moving forwards and exchange views on what lessons different markets and different technologies can exchange. Thank you very much to our audience, to all the panelists, and of course again to Orrick, Italy, and Foresight, and have a great evening from the Inspiration team.